Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me is Kevin Nicholson, Fixed Income Co-CIO at RiverFront Investment Group Global, to discuss where investors should remain overweight and how risk management should be used to protect against drawdowns. Kevin, it's great to have you with us. Welcome to Trade Talks.
Thank you.
So you continue to favor domestic equities over fixed income and international equities. Tell us why against the economic and corporate backdrop.
Well, coming into the whole COVID shutdown, the U.S. was doing much better than the rest of the world. And we believe that once we get through COVID and get through the U.S. election, that 2021 is going to be very positive from an earnings standpoint. And you're going to see growth pick up here in the U.S. And so we think that the U.S. is going to actually continue to outpace Europe. For instance, in international markets have yet to reach their highs from 2018. And whereas here in the U.S., we continue to make new highs, even though we've had a recent pullback. So that's why we continue to like the U.S. over international. And when it comes to fixed income, rates are just absolutely too low right now. When you have a 10-year that's hovering around 65 basis points, it doesn't provide any return for the investor. So that's why we favor equities, domestic equities specifically over fixed income.
You made a really interesting point as well that companies have been focusing on keeping operations going this year, not laying anyone off for 2020, but 2021, they're going to start to look to right size the business and focus more on profitability. So that should also lend to the equities case as well.
Definitely, because coming into at the beginning of the pandemic, many companies made the pandemic pledge so that they were not going to lay off workers throughout this course of time. However, when you start thinking about a business that is slowing down, folks are going to look at 2021 as right-sizing their operations. And when they right-size their operations, companies have a lot of experience in doing this. Typically, they don't bring back or they cut their workforce because that's their biggest expense. And as we move forward, we believe that you're going to see a job-like recovery for that very reason, because a lot of those furloughed workers are going to turn into permanent unemployed workers, and is going to broaden that skills gap that we think that we're going to see going forward.
So then, Kevin, how are you positioning portfolios for the short and also for the long term?
Sure. So we manage two types of portfolios. We manage a shorter time horizon portfolios, those that are within 5 years. And then we have those that have a longer time horizon. For those ones that have a longer time horizon, we are continuing to be growth oriented. We continue to overweight technology in those portfolios. For those portfolios that have a shorter time horizon, we have technology, we've dampened that. We basically are neutral relative to the benchmark. And then as far as other sectors, we brought some more cyclicality into those portfolios. However, on the fixed income side of things, we're buying corporate credit at the front end of the curve. So that three to 7 year part of the curve, we have bought corporate bonds, and we've barbelled this with a strategy of buying treasuries at the long end of the curve. And that's in order to dampen the volatility and create a shock absorber if we have those drawdowns in the portfolios.
Well, speaking of volatility, clearly everyone's expecting that through the end of the year with the election and, of course, COVID-19, as well as where stocks are valued at this point. So, what does risk management look like through the end of the year? There's knowns, but there's a lot of unknowns with that.
There's definitely a lot of unknowns. So what we have proposed, especially in our shorter time horizon portfolios, is that we remain slightly overweight to domestic equities. But one of the things that we've employed trailing stops. So as the market was making new highs, we kept moving those stops higher and higher. So anytime we would have a pullback, and if we hit one of those stops, we reduce some of our equity exposure. So you're basically taking some profits at that point and taking some of your chips off the table to make sure that you rebalance your portfolios. And we think that this is the prudent thing to do in a market like this that has come back so dramatically after the drawdown that we had in March.
Yeah, 2020 seems to be the year where 3 to 5% of the up and downside, for each trading session is become the norm. So I can imagine, that's a challenge.
For sure.
All right. Thank you so much, Kevin, for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.